Welcome to The Explainer. Today, we're doing a high-level boardroom briefing on a structural decision that can absolutely make or break your growing enterprise. If you're a founder scaling your commercial operations in Tajikistan, hitting that statutory 1 million TJS gross revenue threshold, that's a massive milestone, but it also forces a critical decision. Today, we're unpacking a fatal structural blunder that countless founders make right at this exact threshold, one that is literally hemorrhaging their capital without them even realizing it. Okay, let's dive into this. Why on earth does corporate prestige end up costing you 159% more in taxes? Well, this gets to the heart of a massive misconception in corporate structuring. All too often, you'll have well-meaning, conventional legal advisors counseling business owners to incorporate a limited liability company, an LLC, simply for that perceived corporate prestige. But here's the kicker. They advise doing this while electing to remain on the Simplified Tax Regime. As you'll see today, buying into that corporate prestige just for vanity's sake, it can actually cost you 159% more in effective taxes. Let's look at exactly how we're going to break this down. So here's our agenda for today's financial autopsy. First, the architectural crossroad. Second, the legal separation of wealth. Third, the dividend tax trap. Fourth, the strategic blunder. And finally, Treasury control via Odoo. Starting off with Section 1, the architectural crossroad. The choice between an IE and an LLC. When your enterprise scales toward that 1 million TGS threshold, you face a major choice. Do you maintain your individual entrepreneur certificate or do you incorporate an LLC? To an uninitiated founder, the baseline numbers create a really dangerous illusion. You see, the simplified tax regime is typically structured as a 6% simplified turnover tax plus a 1% municipal surcharge. So that equals a 7% composite turnover tax. Now, mathematically, on the surface at least, this 7% looks absolutely identical, whether you're operating as an IE or as an LLC. It feels like a safe horizontal move, right? But actually, scratch that, it's not safe at all. That assumption is hiding one of the most destructive structural errors you can make. To understand why, we really need to look at the law. Moving on to Section 2, legal separation of wealth. Who actually owns the cash? So the crucial point is that the crucial cause of this trap lies entirely in how corporate law views the separation of ownership. If you're an individual entrepreneur, you and the business entity are legally inseparable, like you're one and the same. That means when you pay your statutory 7% turnover tax, all that remaining capital is instantly considered your personal after-tax wealth. You can walk right up to the ATM, withdraw physical cash, or transfer funds to a personal account with absolutely zero additional tax friction. But an LLC is a completely distinct judicial person. The revenue generated belongs exclusively to the corporate entity, not to you as the shareholder. You can't just reach into the company bank account. Extracting that cash requires a formal legal distribution process. There's a very, very hard legal boundary here. The reality of corporate finance is absolute. LLC net profits equal corporate cash. And pulling that corporate cash out for your own personal use, well, that triggers a formal event. Under standard Central Asian and Tajik tax codes, when a shareholder withdraws net corporate profits from an LLC, the law explicitly classifies that transaction as a dividend distribution. And that, my friends, brings us to the core conflict of our briefing today. Section 3, the dividend tax trap. The mandatory 12% hit. And this brilliantly illustrates exactly what we're talking about, because dividends aren't free. They are subject to a mandatory 12% tax withheld right at the source. Let's run a quick simulation on exactly 1 million TJS, and we'll take this nice and slow. Scenario A, you stay an individual entrepreneur on the simplified tax regime. You generate 1 million TJS, you pay your $70,000 in turnover tax, leaving you with $930,000. And because you're an IE, the dividend tax is zero, that $930,000 goes straight into your pocket. Your effective tax rate is exactly 7%. Boom. Now look at scenario B. You incorporate an LLC on that exact same simplified tax regime. You generate the same 1 million TJS, you pay the exact same $70,000 turnover tax, so your corporate cash base is $930,000. But to get that remaining $930,000 into your personal pocket, you get slammed with that 12% dividend tax. That is a brutal hit of over $111,000 TJS. Your net cash retained drops to just $818,400. By simply choosing the wrong entity structure for the exact same revenue, you suffer a massive unrecovered capital loss. And this number right here is the punchline. 18.16%. By incorporating an LLC but staying on the simplified tax regime, your effective tax burden on personal cash extraction doesn't stay at 7%. No, it explodes to 18.16%. That's an astronomical 159% increase in your tax burden simply for the vanity of having LLC attached to your name while staying on a simplified turnover system. Wild, right? Which leads us to Section 4, the strategic blunder, paying general taxes with no commercial perks.
Now, what's really interesting about this is why this 18.16% burden is strategically worse than simply paying standard corporate taxes. Why is this such a colossal architectural failure? Because you're bleeding capital without gaining a single B2B commercial advantage. An 18.16% burden on gross revenue is mathematically equivalent to, or honestly sometimes even worse than, operating under the full general tax regime. You know, the one with a 14% standard VAT and an 18 to 20% corporate profit tax. When your LLC stays on the simplified regime, you can't issue VAT invoices. This instantly brands your business as a toxic counterparty to larger enterprise buyers and supermarket chains who completely rely on input VAT offsets. Plus, you can't deduct documented operational expenses like flour, meat, electricity, or your rent from your tax base. Your 7% tax is levied on your gross turnover, regardless of how razor-thin your profit margins might be. So, you're paying enterprise-level taxes while wearing a straitjacket that literally prevents you from doing enterprise-level business. This brings us to what I like to call the golden rule of entity architecture. Never incorporate an LLC just to stay on a simplified turnover regime if your primary strategic objective is cash extraction. It's that simple. If you just want to pull cash out of your business to buy groceries or pay your personal mortgage, stay in IE. An LLC should really only be incorporated when your enterprise is actually prepared to graduate into the general tax regime, where you can leverage input VAT offsets, deduct your operational cost of goods sold, and secure those major contracts with big institutional supply chains. Let's move to Section 5 and see how this builds into Treasury control via Odoo, achieving absolute compliance. So, how does a modern CFO actually protect the enterprise and ensure absolute fiscal compliance here? Well, first, a stern warning. Many founders realize they're trapped by this 12% tax and try outsmart it. They use the corporate bank account like a personal piggy bank, paying for residential rent, private cars, or family vacations directly from corporate funds. Listen to me. Unless you want the tax authorities setting up a permanent desk in your office, do not do this. Under tax administration, auditors will immediately reclassify all those undocumented personal corporate expenditures as constructive dividends. And they won't hold back. They'll hit you with the mandatory 12% tax retroactively, slap on 20 to 30% statutory evasion fines, and penalize you with compounded daily interest. You cannot outsmart the tax code with a corporate debit card. You need systemic architecture. To maintain absolute compliance, you need strict Treasury controls using an ERP system like Odoo. The first phase is automated expense validation. This basically means your Odoo system must be configured to automatically block any corporate bank disbursement that lacks a verified API-matched fiscal vendor invoice or a proper business travel authorization. If it's not a verified business expense, the system simply does not release the funds. But what if a founder genuinely requires temporary liquidity? Well, Odoo structures that disbursement not as some informal, undocumented drawing, but as a formal, legally executed shareholder loan account complete with statutory interest rates and defined repayment schedules. This legally shields the transaction from being instantly reclassified as a hidden 12% dividend tax during an audit. It's brilliant, really. By understanding the raw mathematics of cash extraction and utilizing strict ERP Treasury controls, a financial architect ensures that corporate growth actually benefits the shareholder rather than just enriching the tax authorities because of a structural typo. So, I'm going to leave you with this final provocative thought to reflect on regarding your own fiscal architecture. Look at the structure you're operating today. Is your corporate structure translating your hard-earned growth directly into retained personal wealth, or are you silently bleeding your capital to the 12% trap? The math doesn't lie, and now you have the blueprint to fix it. Thanks so much for joining me on this explainer, and we'll catch you in the next one.